Okay, I'm going to give this a shot here. I'm on a different computer here in my office, and you guys know how amazing I am with technology. So those of you old timers that were here the very first day that we opened this trading room, you will remember the travails that we went through. But it looks like my mic is working. It looks like the video is working. So we'll get started, and hopefully I can share the appropriate screens. Good grief. I'm on my monitor that has a ton of different screens, so hopefully I'll be able to keep track of this. But this is awesome. So I had no idea how many people would want to attend something like this, and I thought maybe we would get a handful, maybe a dozen or so. And it's showing right now we've got 63 participants, which means that we're on the right track. It means that we probably should do more of these going forward. And in fact, as I was just thinking about some of the things to talk about here in this session, I was looking at a heat map and I thought, my goodness, what another great topic, right? So I've already written that down for maybe our next session, training session, to go through the heat map and show you how vital that can be at helping you find opportunities in the market before maybe they become opportunities. Okay, so let's go ahead and let's get started here. Obviously today, so this session, again, it's something that I want to kind of do on a regular basis. It would usually be on Tuesdays or Thursdays. Maybe we do one or two here or there on the weekends. We'll just see how time allots itself. But I wanted it to be a little bit more interactive. I had thought that maybe we would be able to unmute everybody, but there's just too many people on. And so we'll go back with the same formula as before. If you do have a question or a comment, just throw it into the Discord chat room, and I've got that screen up here as well, and I can see those and respond to them. Today we want to talk about the wheel strategy, and the wheel strategy is a great strategy, but every strategy is a great strategy for the right situation. There is no panacea, and all strategies have pros and cons. And so today we'll try to weed through not so much the pros of the wheel trade, but some of the cons, and so that you can figure out whether or not it is a trade that's appropriate for you. All trades serve different purposes, right? But the wheel trade is an interesting strategy. And of course, you guys are familiar with this. We're working on one right now inside of our account, and we'll continue to look at opportunities like the play trade. But the wheel strategy is an idea where we find something that we want to buy, we want to own it, we feel good about it. This is something that we want in our long-term portfolio, but we want to buy it at a discount to the current market prices. And so the way we do that is sell a cash secured put to put us in a position where we are obligated to buy it at a lower price. If we get assigned, we get it at a lower price. If we don't get assigned, we keep our premium, we make a little bit of money, and we go about doing it again. Once we get assigned, we turn around, start cash flowing it with covered calls. We're doing something very, very similar to this program. I will say quite successfully, quite profitably inside of the asymmetric trading system. So I like the wheel strategy. At the end of today's session, I will show you my version of the wheel strategy. I use a little bit different approach in the wheel strategy. It's a very secret, proprietary approach to trading. Now, you guys will recognize it the minute I show it to you, but it is a different approach to the wheel philosophy or the wheel concept, okay? So a couple of things here just to get started. I want to go through the 5 criteria that I use when I'm looking for a wheel opportunity, and then we'll jump right into some of the trades that you guys have given me. So Greeks, JR Driller, Kev P out of the UK, and Vitor, you guys were all kind enough to offer up, in some cases, 3 or 4 different ticker symbols for us to take a look at. And so we'll try to pound through those and see if they in fact meet our criteria or not. Okay. So the first criteria that I look for is a nice chart. Okay. Now there are two ways to value a company. There's fundamental analyses, there's technical analyses, and the saying kind of goes that fundamental analyses helps us determine what we want to own. Technical analyses helps us determine where we get into that ownership, right? So technicals tell us where and how to trade. Fundamentals tell us what to trade, if that makes sense. So the first thing that I look at, I start at the chart, because if the chart's ugly, man, it doesn't matter how amazing the company is, the strategy is probably not going to work. We're going to run the risk of getting pushed down through our cash secured put, and we'll start the trade-off in a big hole, which is obviously not what we want, right? So the number one thing that I look for is a nice chart. Number two is good fundamentals. So remember, this is a strategy that is a little bit more buy and hold. It's a little bit more long-term, and this is a company that you want to have in your long-term buy and hold portfolio. So, you know, I am a trader through and through. There's no question that I am a trader. I would not call myself an investor, but just from a prudence standpoint, it makes sense for me, and I think it makes sense for all of us to have a well-diversified approach to managing our money, and part of that is having long-term buy and hold positions, right? So I do have, I'm not Warren Buffett by any stretch of the imagination, who sometimes forgets about companies that he has purchased because he's so infrequently sells them. But I do have companies that I've put money into going back to 1995 that I've never sold. So not very many and not very much money in those, but I do have some buy and hold positions. So number two would be good fundamentals, good, solid, strong fundamental companies. Okay. Number three is decent implied volatility. So the overall strategy, the overall idea here is to ultimately own something in our portfolio that we can hold for the long term and write covered calls against it and bring in a nice income stream. I was DMing with one of you earlier about my son's account. I was in here today trading with my son. We did a trade on Tesla that you guys will see in his account tomorrow in Zoom, and I'll walk you through that. But I was talking with him about this idea of implied volatility and how important it is as traders. And so it's important for us as well. Decent implied volatility. We need the ability to have a good ROI on the trade if it quote unquote doesn't work. Okay, now this is one of the bigger challenges. So you'll see this today as we go through ticker symbols. People will find companies that are awesome. They've got a great chart pattern. They're going up in value. It all looks great. But you look at the options pricing on it, or the options premium rather, on selling a cash secured put, and it just doesn't make any sense. It does not make any sense. There's no return on that. And so again, there's this twofold process that we want to be able to have a decent return that we're happy with, even if we don't get triggered into the stock. What is a decent return? Well, a lot of people that do the wheel strategy say 2% a month, 2% a month, 24% a year. The rule of 72 would tell us that from compound interest standpoint, that would double your account value every 3 years. So can you imagine going 12 months doing the wheel strategy and never getting assigned, right? You never get assigned. All you're doing is selling cash secured puts. You make 24% for the year. People are like, how's it going? You're like, it's going horrible. I haven't had a single trade this year work out, and I'm on track to double my money every 3 years. So that's the challenge. Sometimes we find good candidates in terms of, yeah, I like this. It's a good company. I want to own it. But there's no implied volatility there. There's no option premium. It doesn't make sense from that standpoint. Okay, so number three is decent implied volatility. And with that, Along with number three, implied volatility comes volume. This is another challenge. On a lot of the scans, I will tell you, I'm going to get into the software that I use here in a moment to look at these opportunities. On a lot of these scans that I find companies, the biggest problem that I find is that they are illiquid companies. They're illiquid. So they just simply don't have the volume. They don't have the open interest. They don't have the contracts being traded in a quantity that would give us the liquidity or the pricing that we need. We kind of had that problem just a little bit. It was okay, but that problem kind of existed just a little bit in our YUM trade. You saw some pretty wide spreads. You saw your profit and loss numbers changing quite a bit, back and forth, and it was just only the difference was the quote was being pulled from the bid side versus the ask side. So number three is decent implied volatility and good volume. Okay. Number four, it needs to be optionable. Okay. This is a critical thing. Sometimes we look at a stock and we like it, but it's not optional. It doesn't have options on it. Obviously, we can't do the wheel strategy with it. And with regards to options, it needs to have viable strike prices. Sometimes, you're looking at vehicles that they just don't have the number. They don't have the activity. If they don't have the open interest, if they don't have the volume, they may not have the strike prices that we need. And we can't get positioned as properly as we would like. Okay, so number four, it obviously needs to be optionable. It needs to have the strike prices that we're interested in. And then last but not least, number five is it needs to have a good ROI just on the options sell itself. So I kind of touched on this already, but it needs to be able, the trade needs to fail, right? Like our play trade, I think we are 3 or maybe even 4 roundabouts into our wheel experiment on play. Where we have not been exercised, but that's okay because the ROI on it has been great. It's been fantastic. So we need to be able to look at the trade and say not only, yes, this is a company I want to own. It's $40 a share right now. I think it's a great value at 40. I would be thrilled if I could get it at 35. We need to not only be able to say that, but we need to be able to say, but if it doesn't hit 35, the income I get from this put would make me satisfied. I would not be displeased either way, no matter what happens with the trade. Okay, so those are the 5 things that I look at. Now, I'm going to try to see how well we can do this here on this computer. I'm going to try to come over here and let me see if I can share this screen right here. Okay, I think that's working. I hope. Now I lost my. All right. Yeah. Okay. So I can still see my Discord. So if you have a question or if you have a comment, you can jump in on Discord. So this is where I get started, and I've told you guys this before. I spend about $8,800 a year on software, and a lot of it is just for convenience sake. Okay. Some of them do some kind of cool proprietary things. Spot Gamma provides data on strike prices and where pressure points are, points of control, things like that. You will see a software program illustrated in my candlesticks in August when we start the scalping program that is proprietary. But mostly all of this information that I show you is available publicly for free. Okay, and so we can talk about where to go and find this as you go forward. Yeah, there's a little bit more work as you try to manually pull all this information rather than having somebody just gather it for you. But anyway, I was talking about the heat map just a moment ago, and I do think that maybe our next training session, it would be a good place to go. One of the challenges that you have so often is there's 14,000 things trading in the market. And, every day we wake up and we're like, my gosh, look, I know I don't care what the market's doing, right? I know there is a trading opportunity today. I just don't know what the darn thing is, right? And I don't even know where to start looking for this needle in the haystack. And the heat map is a great place to start with that. And so maybe our next one, we will talk about how to use the heat map. But I've gone through this with you guys before several times, but it bears repeating sometimes. As we do research, I go look for a stock, and there's a couple of things that I look for. Okay, we talked about this. We look at the charts, we look at the technicals. Okay, we look at the inner circle, and so this is legal. This is legal insider trading. This is what is happening inside the company with highly compensated individuals. Theoretically, nobody knows better what the health of a company is than the insiders, right? The CEO, the CFO, all of these board of directors, and et cetera. And so if they're buying, that's probably a good sign, right? I mentioned to you guys many times a micro company, micro cap company. This was like a $30 to $50 million valuation company, so a very small company. And the CEO had taken out a home equity line of credit on his house. You know, this is a CEO making 150 grand a year. This was not Jeff Bezos. You know, took out a home equity line of credit on his home to get money to buy more of the company's stock. If that's not, you know, if not putting your house on the line is not a show of faith, I don't know what is. And so you can find opportunities like that. This is all publicly available information. What the insiders are doing inside of that company, and then institutional ownership. You've heard this phrase with a lot of these meme traders, the Wall Street Bets group going around now today, diamond hands and paper hands, right? Paper hands are novices. They are very shallow pocketed individuals. They can maybe they're amateurs or novices or new traders, and they are very skidded. They're scared out of trades very easily. Okay, so they have paper hands, right? They're not going to hold through a little disruption in the trade. The minute they start seeing red, they run for the hills. Diamond hands, those would be institutional ownership, right? They are a little bit more savvy, and they will hold on a little better. So the greater percentage of ownership in the company that is institutional, generally the more stable the company will be. Okay, so we look at charts, we look at the inner circle, we look at valuations. This is the fundamentals. This is PE ratios, price to book ratios, price to cash ratios, price to sales ratios, all that good stuff, right? When we were looking at the price to sales ratios a few weeks ago of AMC, and you know, we said, okay, based on those numbers, my friend's lawn mowing business that his son has, that he brings in $40,000 a year, if it was the same P to S price to sales ratio as AMC, he should be able to sell that lawn mowing business for $5.5 million. You know, so you can kind of see what's a ridiculous number and what is a good number. Fundamental analyses. This is just, you know, all of the nuts and bolts of a company. It's how much growth do they have in sales, assets, and equity, and how is that growing or not growing? Profitability. You know, your profitability on your margins. Is it expanding or is it contracting? What's happening with your cash flow? What's your earnings trends? All of the nuts and bolts of any company. If you are a small business owner, and these things are vital to you, right? They're absolutely vital to you. And then, of course, we look at options. You know, it needs to be optional, right? So these are the things that we look at in our trade. So yeah, without further ado, well, and I'll show you my scan. So obviously, we would like to have charts, the inner circle valuations, fundamentals. We'd like to have all of those things lined up, right? So when I go do a scan, there's lots of scans. Well, it's already pulled up right here. I was just going to go look at some scores. And one of the things that is my favorite is scores, all green, all current. So these are companies that are flashing a green sign on all of these items. Okay. So again, this doesn't necessarily mean that this is these are the best trades in the world, but this right here is where the rubber meets the road. Right, this right here is the work when you are a trader. And I've said this many times, you know, we jump into Discord or into Zoom and I'm throwing trades at you guys. You know, this morning, my goodness, I have no idea. We did a half a dozen trades or something, didn't we, this morning? Something crazy like that. And it's just like boom, 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 boom. And what you don't see and what you don't maybe realize is that there was, you know, maybe 20 to 40 minutes of research done on each one of those trades prior to making those. So there is the concept or the process of understanding a trade, and then there's the process of applying that understanding to the right underlying. And there's 14 plus thousand things, 14 plus thousand underlyings trading in the market today. And this is a pretty typical scan right here. I'd say this is pretty typical. Come up with whatever strategy you want. I want to go do an iron condor. I want to find something to short. I want to find whatever it is, whatever your strategy is, go run the parameters for that particular scan. It's going to scan through 14,000 underlines and it's going to come up with maybe 5 to 30 names. And then that's where your homework starts, right? So I'll just tell you right now, I've already looked at these and I'm very interested in Riot. So we'll look at that, but we'll go through here now and we can look at yours. And so again, if we have other ones, we'll look at them, we'll compare them all, and we'll see if you guys have any comments. If somebody can just throw a quick comment into the Discord, just so that I know that you guys are seeing and hearing me, that would be great. Because I haven't seen any comments, and I hope I'm not just talking to myself here. And I hope that you're seeing my screen as well. So I'm going to bounce over here. Come over here. Let's go. Let's go to this one, maybe. Yeah, let's try this. Let me come out of here for just a second. Oh, yeah. See, now I'm seeing all the things. Let's see. There's all kinds of questions. Screen share is no good. Okay, that one's better. Okay. All right, I'm with you now. We're on board now. The minor technical difficulties, minor. Okay, so let's go through a couple of these. Greeks, JR Driller, Kev P, and Vitor, you all gave us some to look at. So you guys, let's look at this as a group and let's see what you guys think. Okay, first one, we're going to go through Greeks first. He has ticker symbol F, T, Apple, and Costco, COST. So we'll look at these. See what we're looking at. Okay, so here's the first one. This is, let's get a little bit more room here on the chart. Let's move this back. So this is Ford, right? Oh, by the way, a video that I'm working on tonight is maybe one of the best combinations for indicators on a chart. Okay, there's 200 plus indicators that you can put on a chart. I'm going to do a quick video tonight for you guys, put it up on the YouTube channel of how to mix and match those, how to make sure that you're not using a indicator that is just duplicating what another indicator is doing. Okay, so that's just a little preview for you. So here's the first thing. Here's Ford, and again, these are probably not the best indicators, but they're close enough. The MACD and stochastics are a very, very good companion when the ultimate oscillator is a little bit duplicative of what is already being showed by the stochastic, but it's okay. So, and then I've got, what do I have up here? The 20-day. This is the 20-day moving average. So you guys know that the 20-day moving average can act as a demarcation point, right? Kind of a support resistance line, kind of a line in the sand. Generally, you want to buy stuff when it's breaking above the moving average. You want to short stuff when it's breaking below the moving average. So you guys tell me, here's Ford. It's been on an absolute tear, right? This is, what are we looking at here? This is like, are we on? Let me get off of that to a day chart. Hold on. We're getting there. There we go. There we go. Okay. So it's been on an absolute tear, going back to May 12th. Gosh darn it. The thing's gone from 11 bucks, to almost 16 bucks a share, right? It is a 20-day simple, 20-day simple. Okay. And we'll talk about maybe in the indicator video, some of the differences between simple and exponential, and where you would use what and why certain things have preference over another. Okay, but let's look at this first of all. So you guys tell me, is this an opportune time fundamentally to jump into Facebook? Let's see what your guys' comments are. Okay, so I see Inyan, you say, yeah, because it's come down from the high. No, going sideways. Ford, not at this price. It depends. Casey's giving my answer. That's my answer, Casey. It depends. Yeah, it's Ford. Your number one stock, Tommy. Okay, so I guess this bears talking about a couple of things, right? There's some of you saying, yeah, it's good because it's rocketed higher, which has some merit, right? Trends tend to continue. The trend is your friend. You've heard that in the marketplace. The trend is your friend. There's the converse to that you're like, well, it's already kind of maxed that out. It's already kind of maxed out its big move. What's the chances? It's gone from 11 to 16, almost 60% move. What's the chances of it going up another 60% in a couple of months, right? So I will just say, for me, from a technical standpoint, this would not be a trade that I would do the wheel strategy on. Okay, and technicals here, we've gone through this list of 5 things that I'm looking at. Technicals are the first hurdle to overcome. Where would you want to buy this? If our idea here is to buy it at a discount, well, I'm going to come back down to the first level of support. First level of support on this darn thing, because it's ripped so hard, the first level of support is down here at about $11.50. Right? What is the premium? I mean, heck, let's go out 52 days. We don't need to go out 30 days. Let's go out 52 days. There's $12. You're going to get 13 cents for that. Okay. It's not horrible. It's not horrible, right? You're putting up $200 to make $12. So it's a 5%, or excuse me, it's what is that? 5% return. But it's in 52 days. It's almost 2 months. So that's not far off. That's not far off from what a lot of wheel traders are looking for. They're looking for about 2% a month. Okay. So, if you're willing to say, I'm going to let that thing sit up here and I won't buy it unless it comes down to 12, that might work for you. But the chances of that are probably not great. And the chart doesn't look that good right now. Chart's pretty weak. Really, this thing has been in a decline since what? Since the first of the month. For the last month, it's done nothing but go down. What has the overall market done? Overall market just gone up, right? Okay, so that's kind of how I would look at Ford. Greeks has T as well. And there's your chart on T. Interesting chart. Right? Interesting chart. T, of course, is the perennial, they call it the widows and orphans stock because, it was in the day a pure utility trade and considered to be very, very safe. And lo and behold, if you look at it, and I don't know what that was, that probably was earnings. I'm assuming that was like maybe earnings right there. I don't know. You had a gap up here and a gap up down and a gap down here. But we are right back down here on this support level. So, we're in I would say we're in a better opportunity. Was it a dividend cut? So we're in a better place to jump in and get this at a discount. You know, obviously, again, in the wheel strategy, we want to buy the thing at the low. Thanks, Helder. So that probably is when they cut the dividend. Probably not a good sign, right? If we come back over here, hopefully this doesn't mess up the screen. You said that the view on this screen was not as good. Let's come over here. Let's look at T. There's T right there. And let's look at it. So from a technical standpoint, it's kind of blah. You can see that right there. It's got a no-go on the technicals. Inner circle, it's sort of medium. There's as much inner selling as there is buying. Valuation is not great. Fundamentals are not great. So there's nothing really exciting about T right here, even though it is down at a buying point. Would that make sense? Let's go out 31 days. Here's the first problem right here, right? You got to be aware of that. You've got a dividend payment coming out. You've got earnings coming out. Do you want to do this strategy through earnings? Generally, no, right? Generally, no. But if we look out 31 days and we say, where was that bottom? Let me move my screen back. I could get the right screen. I believe that's the right screen. So we look out 31 days. And where was the bottom here? Let's say that is like 28. And we look at 28. You know, that's not bad either. That's not bad. It's almost a 10% return. Bringing in $56 on $500. That's better, right? I'm actually surprised. I would prefer that as plain Jane vanilla as that is. I would prefer that over the Ford trade, right? So that's T. Apple is another one. Now remember, one of the things that we're looking at is implied volatility, right? So if we come back to our T trade, our AT&T trade, you can see implied volatility is around 13, 14%. Let's go look at Apple. So Apple, whoops, let's try the right ticker symbol here. Helps if I click on the right stuff. Good grief. There we go. Third try is the charm. And we come in, look at the chart. Okay, now this is a little interesting, right? So we know what the fundamentals of Apple probably are. AAPL. Let's look at those real quick. AAPL. Technicals. Well, yeah, they look good. If we look at this real quickly here, they do look good, right? That's a pretty nice technical pattern right there. That's a beautiful technical pattern right there. So yeah, that's definitely something that looks good. The inner circle, not a lot of buying going on, but that's okay. Valuation, well, you know, Apple has always been a pretty richly valued company, right? You know that we're not going to get into any bargains in valuation with Apple. Fundamentals, they look really, really strong, okay? So yeah, maybe. Where would you want to get on Apple? Well, support is down here at 122. And so if we went out, say 31 days at what do we say, 122, you're going to bring in 50 cents. That's not a very exciting trade, is it? Putting up $1,300 to bring in $49. So again, even though we've got better implied volatility than we just had in AT&T, now you think, my gosh, what would be a better investment, Apple or AT&T? You know, old historic slow growth or no growth versus one of the premier companies in the marketplace, but they wind up being almost the same. And again, Casey, as you point out, wheel trade individuals, they're looking for 2% a month on the cash secured put, 24% a year. So that would still meet the criteria, right? Here's the challenge. Here's the challenge with a lot of these. And we talked about at the start of this that there's pros and cons to every strategy. Here's probably the #1 con to The wheel trade. Okay, this is probably the number one reason why people are get all excited about it, and then like forget about it. I'm never going to do that trade, right? We could go sell this. This looks like a solid setup. It looks like a decent ROI. It kind of meets all of our criteria, right? I mean, my goodness, this is a 92% probability of success trade. Just want to make sure, yeah, I'm on the right screen. 92% probability of success trade. What's the problem with it? I mean, we set up the trade. We're putting up $1,300 to bring in that $50. 92% probability of success. You could double your account every 3 years with a trade like this. It's pretty solid trade. I mean, if you ever get buried in Apple, would you feel a little bit more comfortable with this company, with Apple, than say maybe something else? To where you just kind of go, you know what? I'm just going to close my eyes for a quarter. It will come back, right? Like, I think all of us would feel comfortable saying that if you were buried in Apple right now, a year from now, 3 years from now, you'll probably be fine, right? Pretty solid company. What's the problem? What's the problem? Well, the problem is with this trade, what are we doing again? We're committing to buy 100 shares of the stock, right? So 100 shares, let's put the price at 122. 100 shares of Apple Computer is a $12,000 investment. Okay. Now with margin, it could be just as little as $6,000, but still $12,000 to $6,000. So that's one of the challenges, and you'll see that over and over and over again with these trades where you're like, I really like that. I can come up with $1,200 to sell the cash secured put, but yeah, I don't really want to come up. Either I can't come up with $12,000, or I can, but I don't want to, because that would kill all my buying power for other trades, right? So it's an expensive trade. It's an expensive trade. He's got one more. Greeks, you got one more here with Costco. So let's take a look at that one. Let's come in here. Let's look at the chart first. Again, we're starting with technicals. That looks like a beautiful chart. That is an absolutely beautiful chart. And again, we'll talk about, well, excuse me, we'll talk about technical indicators here later. But man, there were some huge buy signals, huge oversold signals there on stochastics, huge oversold signal there on the ultimate oscillator. Nice buy signal confirmation with your histogram and your MACD crossing over from negative to positive right here, confirming that move up. Excuse me, that would have been a nice trade. But again, it's one of those that, did we maybe miss the boat on it? Did we maybe miss the boat on it, right? So my feeling again would be, at very least, I would want to own it at 378. That's your last level of support. The one thing that gives me pause on that is that 378 level is below the current 20-day moving average. So you know that that's sort of a sticky area for stocks. And if we were to break below that to come down to that 378 level, there's a high probability that we might just continue on down, right? Just don't know. So, but anyway, 378. We do have, it's a little bit more active, right? So we got weekly options in here that we can work with. Let's go out 30 days and look at the 378 level. There's as close as we could get. Again, it's not horrible, right? Putting up $5,800 to bring in $182 kind of meets the criteria of what people are looking for. But again, you're looking at 100 shares, right? So $37,000. So again, that is the number one limiting factor. It's the number one issue with the wheel trade, is how much capital you do have to tie up in the trade. So those are the ones that Greeks submitted. JR Driller, you got a couple as well. I'm going to try to just grab maybe one from each of the rest of you that submitted trades because of time constraints. And I know a couple of you have mentioned this. So JR Driller, if you don't like it, it's his fault. Okay. MARA, Marathon Digital Holdings. So let's just see if it, well, look, that's not a bad looking chart, right? That is not a bad looking chart. It would be around $19 is the support level. What do the options say? It's active. We've got, look at that, 14 million shares traded. 14 million shares traded. It's liquid. It's got open interest. If we went out, let's say 38 days, and what did we say price-wise? 20. Let's go down to 19. We don't really have a 19 one, but we have a 20. And the numbers on that are great, right? Why are they great? Why are they so great? Well, look at the implied volatility. We're going from things that were 20 to 35% IV to something that's 118% IV. It meets two of my criteria really, really well. It's got great IV, it's got great liquidity, great volume, okay? Now, there's only a couple of the criteria, so it doesn't mean that this is the pick for us. Also decent price, right? At 20 bucks a share, it's gonna be a little bit more affordable to be able to buy. So let's go look at Mara. Let's go take a look at this and see what all of the other criteria that we were talking about show us. Casey, good question. Why isn't the buying power half or $2,000? Different brokers are a little bit different on this, but there's a lot of these stocks. Riot, the one I'm going to show you in a minute as well, is the same way. There's no margin. They want you to put up all the money. So that tells you something about the volatility in it, right? So Mara, let's put in MARA. Mara, there we go. Wow. Let me just make sure I'm showing you the right screen. It is. Mara has, I haven't traded it in a while, but some of you guys in here have had some pretty bad burns with this stock. That's why you see the bleach going into the eyes. Look, from a technical standpoint, it holds up. It's good. From an inner circle standpoint, it looks good. There is a lot of insider buying going on. From a valuation standpoint, it's high, as is the case with all of these new companies. But from a fundamental standpoint, from the growth standpoint, again, fairly new company, but growth is pretty darn rapid. You can see what the earnings have been and how those are moving, how those are projected, and analysts target prices. They're raising their price targets. Price target right now on this thing is up to 50 bucks a share. Okay, all of the fundamentals are moving in the right direction. Their cash burn, their operational cash flow, their profit margin, they're all moving in the right way for a new company. So that might be an interesting play. Mara might be an interesting one. Okay, I'm going to circle it. Kev P. Let's come back over here and let's look at some of your picks. We'll grab one here. Yeah, again, so let's just look at those numbers real quickly. And you need to remember, you need to remember kind of what people are looking for with the wheel trade. You know, we are a little tainted in here, right? Like yesterday, I made what, 7.5% or something like that on my 0 DTE, and me collectively, along with a lot of you, were like, oh man, I wanted it to be higher. Yet we made 7% in a day. That's not the expectations for the wheel trade. And it shouldn't be, because the risk is quite a bit different, right? So it serves its own purpose. But if you're talking about 49 bucks divided by 1953 of capital, 2.5% a month, you times it by 12, that's 30% a year. That will double your account about every 28 months, 29 months, about every 29 months, that return will double your account. So, everything has a season, right? As the scriptures say, everything has a season. So I don't know. It's interesting. It's interesting. Okay. Kev P, you've got TTD. And let's look at this. Okay. So this is the trade desk. Wow, that's a wild chart. So again, you have to kind of figure out what type of a trader you are. Are you a momentum trader, or are you a contrarian trader? Now, I lean more towards a contrarian approach to investing. And contrarians just simply says, if you're a contrarian, you use Bollinger Bands a lot in your trading, because a Bollinger Band demarks a 2 standard deviation move, and basically just says, look, when something moves 2 standard deviations one way or the other, probabilities state that we're going to get a revision to the mean and regression to the mean, and that it's going to come back in. It's like a rubber band being stretched too far and it comes back in, right? A momentum investor is, man, look at the trend. The trend is your friend. You trade with the trend. That's one of the #1 rules of investing. Trade with the trend. Do not step in front of steamrollers. Trade with the trend. So the trend is clearly up. There's tremendous buying volume. We don't have volume up here on the chart, but I bet you would see with a candle that big, that volume is not only the breadth of buying and selling is not only skewed to the buy side versus the sell side, but it's expanding, right? There's more and more and more volume coming in than going out. So you can say that might be a good buy. As a contrarian, I'm kind of the guy that's going, you know what? I feel like I've already missed the move here. And so I'm going to put this on my watch list, and I'm going to wait for these indicators right here that are vastly, vastly, vastly overbought right now. I'm going to wait for them to hook and turn down to see about an opportunity to ride it to the downside. Okay. So again, that's no right or wrong way. It's just my personal preference. A couple questions coming in there. Paul, is there an IV range you like to use? Above 50% is always golden. There's a saying with traders that if you can't make money selling options on a underlying that has 50% IV or better, you need to use a better strategy, because there's money to be made. Okay. Those are harder to find without special situations. So you'll see a lot of stocks that'll get above 50% IV, but there's an earnings announcement coming out, right? Or it's a biotech company or something, and they're awaiting phase 3 clinical trial FDA approval on some miracle cancer curing drug or something like that. So, to find 50% IV in something that isn't going to report earnings, doesn't have a major event happening, it can be a little bit of a challenge. So sometimes you're going all the way down to 25, 30% IV. But again, 50% is great on IV. David, we're talking about the entry right now, and all of this analysis is amazing. I love seeing how you're looking at the data. However, once we get in this stock in 30 plus days, assuming successful, where do you sell the covered calls at? Do we dump the stock if low IV is low? What are some of the criteria do you use once we get into the stock? So yeah, we haven't had, we've had several slices of the pie here with our wheel trade on play, but we've never quite got into it to get to that point really in the process, right? Of selling covered calls. Where you sell it is largely a personal decision. And it's very much the same process that we are going through right now when you guys ask me questions about where, if at all, should I cover my hedge, my long futures contract or my short futures contract? And the answer is, well, it depends. Depends, number one, on your outlook, right? Do you think this thing is going to keep ripping higher? Well, then you probably want to sell a far out of the money call, right? Do you think that it has maybe topped out? We have some positions in our asymmetric trading system that we are selling almost at the money. We're selling almost at the money calls on them, right? Because they've almost topped out. And or, so it's number one is your view, what do you think is going to happen? Do you think that this is going to shoot up or that it's kind of maxed out? Number two is, what are you looking for? Are you looking for certainty or are you looking for opportunity? The further out you put that covered position, the more opportunity you have, right? It's unknown, so there's no certainty, but there's maximum opportunity. You're not really capping your gains. If you're the opposite of that and you're looking for certainty, it is very, very common with wheel traders to not only put their covered position at the money, but put it in the money. Actually put it in the money. They'll put it $1 in the money and they bring in $1.38. So you're going to still net 38 cents on the covered call, but you've already committed to having that stock called away from you, right? But you've got $1 of downside protection. Just depends on you. Depends on what are you looking for. Are you looking for certainty? Are you looking for opportunity? And what's your bias? What's your belief about that? Okay. Mark, what do you think of doing weeklies for the wheel? It's a little tougher. It's a little tougher. You would need enough IV and enough volatility that it would almost negate being a good long-term hold, if that makes sense. To be able to make money on a weekly basis, to where it's substantive enough, you'd have to have enough volatility that it may not meet our criteria for a good long-term hold. Okay. Guybrush, you got a trade in there. Oh, that's where I was going with this. That's where I was going with this. I started a diatribe on my son, and then I lost focus on what I was talking about. So I was talking to one of you guys about how the heck he turned $3,000 into $13,000, which is now back up to almost $11,000 with today's Tesla trade that you guys will see in his portfolio tomorrow. But the bulk of that $3,000 when he started was all in one trade, and it was a wheel trade, and it was SPG. It was trading about 60. He put it in at 50. He rolled it 1 month with it expiring. It was coming down, so he reset it at 50. He was triggered in. He bought it at $50 a share. He got 200 shares at $50 a share because he used margin, and that stock went up to like $100 a share, $110 a share or something before he ended up selling it. And he was writing covered calls along the way. So the bulk of his account came from one trade. And you can see the potential there with Guybrush's example for it. Okay. So, okay, there's TTD. Vitor, you've got a couple in here, and let's look at Sun. You've got Sun in here. Let's take a look at that. It's not a bad looking chart. And from a technical standpoint, that's a pretty darn good looking chart. This chart right here on Sunoco, it's an oil company. The only concern that I have with this, well, not the only concern, but one of the things that just pops into my head immediately is this is a refiner, right? This is an oil reserve company. Their price is very inextricably tied to oil. And if we look at oil right now, you can see that oil is not at all-time highs. You guys know oil's been way, way higher than this, but in recent history, we're pushing these highs And we're finally just starting to see a little exhaustion in that pricing power, right? And so, again, that doesn't necessarily mean everything, but when would you want to jump in and buy something? When it's being sold at 50% off, or when it's being sold at retail plus 30%, right? Oil is really, really expensive. Now, again, it's very much like the market, right? The market is at all-time highs. The market's very expensive. That doesn't mean that the market isn't going to keep going higher, 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 higher. But probabilities would tell us that there's probably more downside in the market right now than upside, right? Kind of the same feeling with oil. And so that's going to kind of affect our SUN trade. But that is a good looking chart because it is a chart very, very much like the market. The market has, if we were to superimpose the NASDAQ or the S&P on top of this, or the Russell, every single time in recent history that the market has dipped and even broken below its 20-day moving average, all that has meant is not a change of bias, not a change of direction, but a buying opportunity, right? It was just a healthy pause that refreshes. It was the company coming down, building. This is a healthy bull market, right? When you see something that just goes straight up and up and up, that's not healthy. You know there's going to be a crack in that foundation at some point. You're going to get a big drawdown. This is a healthy bull market. You see the ebbs and flows, the pauses to base build. And we're sitting right now down around that 20-day moving average. So I like the chart of Sun. Now, how tradable is it? Well, 152,000 shares were traded today. It's not illiquid, but it's not the most liquid thing out there either. And you see that immediately. You probably don't even need to look how many shares were traded to know that, because you'll look at it and what do you immediately see? It only has monthly options, right? If something has weekly options, the research kind of been done for you to know that it's probably pretty liquid. It's pretty actively traded. That's why it's got weekly options, right? So in this case, we would be forced to go out 52 days on this. I would look at support down in here around the $34, $35 range. There's 35 right there. I don't know. That's a little tight. That's a little tight for my preferences, but it is a good rate of return, right? That's a really, really good rate of return. So if Sun is a stock that you really feel comfortable about getting in, that might be a one to look at. Let's look at the research on it real quickly. Let me put in the ticker symbol and then I'll move the screen over here. While I'm doing that, Natty, you've got a question here. See your question. What if when we own the stock, it keeps going down? Do we sell the stock at a price we were assigned at minus premium received? So a couple things. Number one, you always keep your premium, right? Whatever happens, you keep your premium. And so let's just use simple math. Let's say that we found a stock at 35. We committed to buy it at 30. And we did that by selling a 30 strike price put. And by selling that put, we brought in $1 of premium, right? So if the stock comes down and hits 30, you're going to be assigned. You're going to get that stock at $30 a share, okay? But your actual cost basis is 29, right? You will have to buy it at 30, which is what we agreed to, but you brought in $1 of premium, which you keep. So your actual cost basis is 29. So that's the first part of your question. The second part is, what if it keeps going down? So this is where the fundamental analysis becomes important, right? Because that's what allows you to hold through those lows. That's what allows you to buy Apple, for example, and whatever, you just mistime it. My goodness, the day after you buy it, the Fed raises interest rates out of nowhere, right? And we get a 5% drawdown in the marketplace in one day. I think we would all say, okay, this is not good, and I'm in a loss position on my Apple shares, but you know what? You're going to have a hard time convincing me that a year from now, 2 years from now, 5 years from now, Apple is not many times higher than what it is today. They're pumping out cash, right? And we feel good about that because we've looked at the fundamentals of it. So again, this is a company that you would feel very comfortable about owning long-term. This is not anything like we're doing in our trading room right now, where I give you guys a bonus trade at 7:40 a.m. Mountain Time, my time, 10 minutes after the market opens. And an hour later, someone in the chat room is like, "Oh my gosh, what are we doing now? Are we gonna bail? Are we gonna bail? What's happening?" You know, like, dude, you are measuring the length of time that you've been in this position by minutes. Let the thing develop, right? This is something that you want to own for 5-10 years. So you got to be comfortable about the paper ends. You got to be comfortable about the fundamentals, right? What is the minimum open interest? So it does vary from company to company. I will tell you again, really easy way to kind of judge if there is enough open interest. Yeah, okay, well, you're talking about open interest. Okay, I'm sorry. So there's volume, right? There's volume, how much stock has traded, and then there's open interest. So let's look at that for Sun for just a second. Let me come back over here and let's look at that. So yeah, we got this stock, you know, all day long it's traded 152,000 shares. We're looking at this August 20th expiration. It's 52 days out. Let's go look at open interest. Okay, there you go. So let's not even bother with the put side. Let's just look at one side here. Let's look at the calls, okay? And you see these numbers right here on the call side. What's that tell you? There's a lot of tells in the marketplace, right? So what are the tells here? What is this telling us? Well, number one, it tells you where the action is, right? I mean, all of the action in this darn thing is right in here. All of the action is right on these three strike prices. And number two, man, it depends on how much you're trading, right? I don't know if you guys watched the video link that I put up of Paul Tudor Jones. Just, I feel blessed to have met the guy. I mean, I honestly, to me, he's the best trader I've ever known. He is the best trader I've ever known. And you know, his problem, and his problem is way worse now than it was back then in the 80s when that video was done. His problem is moving the markets, right? He's trying to spread his trades around through different brokers to camouflage who's doing what so that they don't catch on that he's moving the market, right? He literally moves the market. Okay, you know what? Not if you got 5-10 grand, but if you got a $250,000 account, you can move the market. You are a big enough trader that you can move the market. If you think you want to come in here and do something on these 35 strike price calls, and the entire rest of the stock market cumulatively has done 34 contracts, and you come in and want to do 34 contracts by yourself, you think you're going to get a good fill? You think you're going to get a good spread? You think you're going to get good liquidity? No. Okay, so again, those are some things to think about. Okay, let me show you mine. And this is I listen. I know the eye rolls were big when Mara came up on the screen, but I don't know. It kind of looked interesting, right? It kind of looked kind of good. Riot is another one where you kind of go, oh boy, oh no. This is a blockchain company, and you can see the craziness that it has gone through, but nice looking chart. Nice looking chart right there. And the other thing that I like about it, you know, Sun traded what, 150,000 shares. Riot is just a little bit higher than that at 15 million shares. 15 million shares. 15 million shares traded today. It's pretty liquid. Okay, it's a pretty liquid holding. And I also like the fact that before any of the mania, any of this blockchain mania really hit it, it was basing quite nicely down here around 17.5. Okay, it was basing pretty good. So the next level up here, what is that? 22.5. It's well below the 20-day moving average. We got a lot of supportive indicators showing here. We don't have any volume indicators. Again, just an FYI, I'm going to try to do a video tonight for you guys on complementary indicators to use on your charts. And volume is one of those, but it's not in here. But anyway, chart looks good. Okay, looking down here around the $22 level. Once again, you don't even need to usually, not always, but you don't need to usually even look at the volume, see how active traded it is when you pull up the options chain and you see weeklies, right? Because the fact that it has weeklies means that it is active enough. It's met certain criteria. I don't know what the stock exchange's criteria are to move from quarterlies to monthlies to weekly expirations. But when you get to a weekly, you're a liquid company. Okay. So we could go out on this one. Let's look at the 31 days, July 30th. It's 1 month out, basically, right? And what did we say price-wise down here? 21, something like that. 21 right there. That's okay, you know. 100 share, it's going to be $2,100. Here's the thing though, right? Let's go buy 100 shares of Riot at $21. How come my broker, how come it's $2,100, right? Why is my broker telling me I got to put up $2,100? The margin's 100% on this. Margin is 100% on this. You know what? Which at $2,100, again, it's really just about ROI, right? That's the key, is ROI. Does it make sense or not? So at 21, we look at that, and it would be 1%. It would be 1% in a month. Okay, so that's not that great. You got to be at least around 2%. You got to be at least around 2%. But you know, it depends on how aggressive you want to be with this, because what am I doing? Hold on. I got this. Open interest. Let's go to implied volatility, because look at the implied volatility. It's got great implied volatility, right? So, you know, if you slid it up to say 29, which is still an 80% probability of success trade, it's just outside the expected range. It is not quite a 1 standard deviation move, but it's close. It's a 16 delta. It's, you know, very close to a 1 standard deviation move. Rid of that. Add that. Now you're talking $2,700 with $113 coming in. That's a fair rate of return. That is a fair rate of return for an 80% probability 30-day, 1 month long wheel trade. Okay, so the question then is, does it meet our other criteria? And so we come over here. We look at, I think it's, there it is right there. Pretty much, yeah. You know, if we look at the chart looks great. We got a buy signal on the chart. Inner circle, you've got a little bit of both going on with the inner circle. It's sort of a caution sign there. It's not a green light. It's not a red light. That's a function that insider lockups have been triggered, and these insiders that were making $100 grand a year, living paycheck to paycheck, now are multimillionaires, and they're dumping their insider stock. They're just cashing in. So it's not necessarily reflective of their views of the company going forward. It is interesting that institutional ownership continues to grow in this. So I'm okay with that. Valuation wise, well, it's interesting. The PEG ratio is almost buried. Now, we won't take the time here to get into the price earnings growth ratio, the PEG ratio. I think it's more valuable than the PE ratio. If you don't know what PEG is, Google that. But that's crazy good valuation. That is a crazy, crazy good valuation. Price to book ratio is pretty solid. Price to sales ratio is good. It's rare to find a company like this that has this kind of growth. You look at the fundamentals, and it's growing like crazy. There's your sales growth right there. Asset growth, net income. They're a startup basically, so they're going from losses to very quickly moving to net income. Profit margins are improving rapidly. They've got good liquidity in the company. Earnings estimates are looking wonderful. So everything from a fundamental standpoint looks pretty darn good on that. So Riot would maybe be one that I would look at. Mara would be one that I would look at. But those are sort of the things, I guess, that helps you guys to think about. Now, let me show you the way that I personally like to do the wheel trade. I do the wheel trade completely different than everything that we've just gone through. This is a very special proprietary approach that you've never seen before, called a credit strangle. Okay. So you guys, we're doing a credit strangle right now, right? If we move back over here, we got a credit strangle right there in XOP. We got a credit, good grief. Oh, let me close my, we got a credit strangle right there in XOP, right? Now, yeah, so that's not a wheel trade. Here's how I think about it. What's the concept behind a wheel trade? Find something that you like, make an offer to buy it at a below market price to help you get long in a good position. And then we add in a cash flow component, right? What's the mirror opposite of that trade? Find something that you think is overvalued, put on a trade that gets you into that position in a short way at an even higher valuation, and then add in a cash flow component. So I know that that's sort of hard to wrap your mind around. It was difficult when we started shorting futures in here because people were like, I don't understand how to cover this. I'm like, do you understand a covered call? Oh yeah, I've done covered calls forever. Okay, this is the same thing, right? Shorting something and selling a covered put is the exact same risk profile. It's the exact same trade as buying something and selling a covered call. It's just inverted. So things go down just like they go up. So in something like, and let's come back here now. Let's come back to, let's come back to Mara. Let's look at Mara. Okay, here's the chart. So you look at this, and right off the bat, I would say a couple of things, right? I would say, okay, well, the chart looks good. It looks bullish right now. And so I like the wheel strategy as it is normally constituted. And maybe we could sell something down in here, right, to get us in at a price down in here. If we did that, what's the numbers? So let's go out 38 days. We're selling this 20. There's the numbers, right? I'm putting up $700 to bring in $50. Not too shabby of a ROI potential, but it could be way better. And this trade could be way more flexible if I just simply went one step further and said, listen, so 20, yeah, I'm interested in owning this if it comes back down here at 20. But you know what? I'd also be interested if it got up in here. I'd be interested in shorting it, right? So I'd be interested in owning it down here. I'd be interested in shorting it up here. That's like $50 a share. So what if I came in on this trade that we're already working on and I went up here and I added a 50. Now there's, in this case, for this month, there's not a 50. Okay, so let's just pretend like it's the 40s. The numbers are going to be a little bit better than what they really would be in real life, because obviously we're going to get more money for 40 than 50, but you'll get the idea. Okay. So, and again, I don't know that that would work. 40 is right there. I mean, 40 is even doable, right? You say 40 is up here at this next level of, it's up above the next resistance level, and it's kind of in the middle of the next resistance. So let's just say that 40 is okay, right? I could come in here and I could sell 140. Now, what have I done here? By selling one contract on each end of those, right? Well, by selling the put, I've committed to buying 100 shares at 20. By selling the call, I have committed to going short 100 shares at 40. I would be okay with both of those, okay? So that's the first question that you always have to ask yourself. I spent a couple of years back in the day lending my capital, lending my portfolio out to real estate investors as hard money loans, 15% interest, 15 points up front. So 20% interest a year. And they were 6-month loans. You had to turn them over every 6 months. So every 6 months, you had to pay another 5 points. They were first lien mortgages. They were first position mortgages, 50% loan to value. So the thing that I liked about that is the worst case scenario could potentially be the best case scenario. What's the worst case scenario in that investment? Worst case scenario is that they default, right? And you end up having to repossess and own the property, foreclose and own the property. Well, if you did your valuations correctly and you're getting that property actually at 50 cents on the dollar, the worst case scenario could be the best case scenario, right? And I had to do that. I had to repossess, I had to foreclose on a couple pieces of property, ended up making more on the foreclosure than I did on the loan, right? So this is kind of the same scenario. You have to ask yourself that same question. What's the worst case scenario here, and are you okay with it? Well, worst case scenario is you get assigned 100 shares of long at 20, and you get assigned 100 shares short at 40, right? But it's a little bit better than that, because how much premium are we bringing in total? 254. So look at these numbers now. Now you're putting up $1,100 and you're bringing in 250. Oh my gosh. Now, these are kind of numbers that wheel traders never see. A wheel trade generally is not going to be able to make 20 to 23% in a month. They're going to make 2%, 3% in a month, right? But now we're making a ton of money, and it's because of the leverage. We didn't have to put up a whole lot more money to do both sides of the trade. So we get better ROI or better leverage, right? And again, you have to ask yourself, are you okay with the worst case scenario? Worst case scenario, you're short at 40, you're long at 20. Short at 40 up here, long at 20 down here. Yeah, I kind of like that. And you know, it's tight. Again, it's tight because we couldn't find the 50 strike price. But if we did find the 50 strike price, that would probably be like an 82, 83% probability of success trade. So that's how I do the wheel trade. I do both sides of that. I do both sides simultaneously. It gives you better bang for your buck premium wise. So that's it, guys. We're at our 47-minute mark. I wanted to go for about 45 minutes. If you have any questions, throw them in the chat room right now. Otherwise, that will sort of conclude our wheel strategy session. Hopefully that was helpful to you guys. We'll do another one. We'll do another one on using the heat map. Okay. Yeah, my double super secret proprietary wheel strategy. Just don't call it a credit strangle and nobody will know. They'll think we have something special. But I think it's a higher, better use. What do we always say about real estate, right? Could you plant corn on your acre property on the beach in South Florida? Well, you could, right? You can do whatever you want with it, But with real estate, we talk about highest and best use, highest and best use. You wouldn't plant corn, you would build a high-rise condo, right? Because that's highest and best use for South Miami or South Florida. With trading, we all have a limited amount of capital, right? What is the highest and best use that you can put it to? You know, I could pull this call out, right? We could pull this call. Let me see if I'm still on there. I could pull this call out and we just get rid of it. My capital goes down to $700, but my premium now goes down to $50. It's not the highest and best use, right? Always think about always think about opportunities to get short and opportunities to get long. And if you can play them simultaneously, it's just that much better. So, all right, guys, thank you so much. I will continue. If you have questions, you can shoot them in the Discord here, and I'll go through and hit them all. Otherwise, we'll see you in the formal Zoom session tomorrow. I'm amazed. 75, 76 of you guys here in this room. So obviously, these are something that we should probably continue. So, all right, guys, take care.